Because rising home prices support construction, banking profits, local tax bases, and consumer confidence. A slowing housing market doesn't just affect homeowners, it ripples through the entire financial system. We saw this in 2008. The problem wasn't just bad mortgages, it was that the global economy had become dependent on mortgage growth. When lending slowed, spending slowed. When spending slowed, growth stalled. And when growth stalled, debt suddenly looked dangerous. So policymakers stepped in, interest rates were cut to near zero, central banks bought bonds. Liquidity flooded the system. The message was subtle but clear: debt must continue. Fast forward to today. Governments run structural deficits, corporations refinance constantly, households rely on credit for education, housing, healthcare. Even financial markets depend on leverage. Hedge funds borrow to amplify returns. Companies borrow to boost stock prices. Private equity thrives on debt. If everyone decided tomorrow to deleverage, to aggressively pay down debt and stop borrowing, growth would slow sharply. Spending would drop. Corporate revenues would shrink. Unemployment would rise. Tax revenues would fall. Governments would borrow even more to stabilize the system. It sounds paradoxical. Being financially responsible at scale can create instability. That doesn't mean debt is evil. Debt builds infrastructure, funds innovation, smooths consumption over a lifetime. A mortgage lets you live in a home while paying it off gradually. A business loan can create jobs. Debt is a tool, but the system's incentives matter. Banks earn from lending. Governments prefer growth to austerity. Markets reward expansion. Politicians prefer short-term stability over long-term balance. No one gets promoted for shrinking the system carefully. So the bias is always toward more credit, lower rates, easier terms, extended maturities. Public messaging celebrates access. Affordable payments. Buy now. Invest with leverage. Growth is framed as progress. The underlying reality is quieter. Growth increasingly requires rising debt levels to maintain momentum. The math becomes delicate. If global GDP grows at 3%, but debt grows at 6%, leverage increases. Over time, more income must go towards servicing past borrowing. At low interest rates, this is manageable. At higher rates, it becomes heavier. We're now in a period where interest rates have risen after years near zero. Servicing debt costs more. Governments face higher interest expenses. Households feel pressure on credit cards. Companies refinance at steeper rates. The system doesn't collapse immediately, it tightens. Credit standards harden, spending cools, growth slows. Policymakers face a choice: tolerate slower growth or stimulate again. This is the quiet tension at the heart of modern capitalism, a system designed to grow, powered by spending, increasingly supported by credit. You, the borrower, are not a side character. You are a transmission line. Your mortgage supports bond markets. Your credit card payments feed bank earnings. Your student loan shapes fiscal policy. Your consumption data influences monetary decisions. Individually, your debt is personal. Collectively, it's structural. And here's the deeper question. If sustainable growth requires ever-expanding debt, what happens in a world where populations age, productivity slows, and borrowing becomes more expensive? Can the system evolve to rely less on leverage, or is rising debt simply the price of continuous expansion? The global economy doesn't just tolerate your debt, it counts on it. The only uncertainty is how long that balance can hold.